Sydney, this is the market which is so amazing. It's the market where we did like to say the undersupply is stopping a crash from happening, but affordability is stopping a rally from happening. So it's like caught between devil in the deep blue sea.
In terms of pure mathematical calculation, it's like roughly on an average 85 years to own a property in Sydney. Now, that's a lifetime. How many of us will live 85 years? The contrasting metric in rest of NSW is roughly 37, 38 years.
For $600,000 to $700,000 apartment, the rentals are in between $650 to $700 a week. So on an average, the rental yields for the apartment is around 4.1%.
I think you rightly say units will still be, I think we've discussed, will still be the only viable play to happen in terms of renting position.
Welcome to the Property Portfolio Podcast, where property, finance and investing are broken down into real conversations, which have benefited thousands over the years. The show is hosted by leading industry experts who bring different strategies to the table. Parag Dixit, Chief Strategist of Infinity Financials and Prop Wealth, has more than 20 years in the financial industry and is consistently ranked among Australia's top 10 mortgage brokers. Rudit Khandelwal, Director at Infinity Financials, has 2 decades of experience and over 200 five-star client reviews. He's known for helping clients build strong property portfolios. Julius Darbre, co-founder of Prop Wealth, has spent more than 15 years in real estate domain. He is a lead data researcher and has helped hundreds of people create wealth through property investment. Subscribe to the channel and get regular updates on what's happening in the property market.
The information in this podcast is of a general nature and does not constitute financial or legal advice. It has been prepared without taking into account your personal objectives or financial situation. Individuals must not rely on this information to make financial or investment decisions. You should seek independent professional advice before acting on any investment decisions.
Hi guys, evening, how are you?
Good. Okay, Parag. Not too bad given what's happening around the world. It's not been one of the best times, especially what's happening in the Iran and Middle East area. I was talking to one of my friends, a couple of my friends were from there. So, of course, everybody has kind of mixed feelings about it and anxious. Not much communication going in and out. So, people are watching very closely. Some have families, extended families living there. So. Tough times.
I know. There's one of our colleagues. He is talking about it that eventually they finally after a week or something they got some Starlink connection, and then you can know about your parents and family and what's happening and what's not happening. That's the sad side of the story, right? That kind of puts a lot of pressure onto you. But yeah, it's a very different part of the story. We don't hear about all of these things. How normal people get impacted by, everyday people get impacted by a war, which are none of the sides, and they really don't know how to deal with it, right?
Stressful and frustrating time. And when the media is also censored, we don't know what's happening there.
We don't know what's happening there. We don't know. We've had people, in the good old days, we would have people who would go out to work, and they've been good oil countries, and a lot of employments used to be there, and a lot of stuff used to be there, but it's a different phase right now. It's a different phase right now. But back again in Australia, it's again even a more weird stage, right? Back 6 months back, rate cuts. Now rate rises. And can you believe it? I was reading today an article which said that if obviously the oil hovers around $100, $120, $130, $140, then we are talking of an inflation scenario, and all this bit will be happening, which means that there will be aggressive rate rises. And there's another guy who's talking about if the oil reaches $200, then we are talking of a recession. Which is recession means that we are now going to go backward on the rate. So it's such a yo-yo. It's such a thing which bewildered at what's happening. It's so amazing that people can just oscillate from one end to the other end within months. That's the kind of world we are living in. Very, very different, very challenging and very difficult. Maybe, I don't know, the last few years has been different, right?
Yes, absolutely. It's been different. I mean, both on the personal front, economic front. So personal front, like you said, so especially when we talk about in Australia, it's a very heavy immigrant country, right? So a lot of migrants have come in, and when something happens in one of the countries back home, then everything shakes for people who have come from that country here. So tough times for them, but economically, absolutely right. The uncertainty about what's going to happen, how long is it going to prolong for, and what impact it. Definitely, the costs of a lot of goods. Moment oil rises, everything, the cost of everything changes. Logistics changes. So not a very good state to be in from that angle, and it is causing a lot of uncertainty for people who are even looking for investment or thinking about that. A lot of questions that people are asking nowadays. Should I stall my plan? Should I think about, I was thinking about now, should I do it now or not? And at the same time, there are people who are saying that, oh, this is the opportunity because there's more confusion in the market. Maybe this is the right time.
It is. It's varying thoughts, varying risk capabilities, varying risk profiles, and how you take it, how you analyze it, how your family takes it, what's your family situation, how secure you're in employment. All of this drives what you think, right? It's just,
Yeah, it is. And then I can see the impact of the fuel prices in most of the places. So towards the regional town centers, the petrol is $3.20 now.
wow.
Yes,
All right.
it is already gone up.
It's already gone up. Yeah, it's a situation which I hope and I really believe that maybe in a few months, a few weeks, it will all come back to normal, and we will all be talking of barbecue evenings rather than on what's happening on this.
Yeah.
But yeah, we'll have to wait for that. But coming back to where we are, I think today we are going to talk about and take the next step in our state of investment series, and we are going to talk about the state of NSW today. We will talk a bit about breaking it down into Sydney and rest of NSW. We will talk about purchase affordability. We will talk about rental affordability. We'll talk about the outlook for both rent and purchase in 2026. We look forward to what do we look forward to in this state and the state of investment positioning, and where and whether we think that this is the market to where people will be looking at investment if everything goes well, and what can we look forward to, and how does it fare across in the various parts of the state. So that's what we are going to discuss, gentlemen.
Yeah.
And I hope we'll do a lot of justice to it. But before we go forward, we'll follow the same index. Let's talk about 25. Okay, now Sydney, and let's start from Sydney. Sydney, this is the market which is so amazing. It's the market where we did, like they say, the undersupply is stopping a crash from happening, but affordability is stopping a rally from happening. So it's like caught between devil in the deep blue sea. It's in that position where it's nothing is there, and you're just stuck in a zone. You're not in a trance zone, but in an uncertain zone. Where it's going to go, we don't know. How it is, we don't know.
Correct. Sydney is a classic example of affordability indexes.
Yeah.
Yeah, so you still have extremely low supply available.
Yeah.
You don't have any supply, low inventory, no houses coming up, but still you can't afford it.
You still can't afford.
Still you can't afford it because median prices are close to $1.6 million.
That's right. Houses, median prices. I don't remember the other states, but I'm very sure there is none which is more than Sydney in median price for houses.
Yes, 1.6 million. But when we compare it with the unit, there's a large gap.
Oh, really?
Yes, the units median prices are close to $905,000.
That's a good 80% or something
yes,
gap.
there's extremely high gap between the houses and the unit, and that's a segment they might feel a lot of pressure.
Yeah.
Because of the affordability crisis.
Yeah, and which is quite different from how it is across a lot of other states, where the gap between house prices and unit prices is not so much. So Sydney stands very different in terms of the affordability of different kinds of assets, different kind of properties. Sydney sits very, very different compared to other places.
I know, and I understand. And this is pretty weird, right? We were talking about the state of Queensland last time, and when we're talking about Brisbane, there we don't have such a large gap between houses and apartments.
Just 20%, yeah.
20%, right? And we don't have such a large gap in the rest of Queensland area when we were talking. We'll be talking about other states. Most of them don't have such a massive, crazy gap. What does that point up to? We really don't know. There's a large oversupply of apartments coming in as well, but there is that's the segment. And let's talk more and more when we get more and more into what's happening in what happened in 2025 or the whole year till now, about what was the state. We've seen that it's not that houses or apartments have not grown. They've grown, right? We've had more than 6-7% growth in houses there. We've had more than 4% growth in apartments, despite what the number of apartments being there, despite the gap between houses and apartments being so large. The growth in the apartments are still falling behind the growth in the houses, despite houses being at a 1.6 million kind of a median value. That's a very different phenomenon. So the houses are huge in demand. Apartments are not that much in demand, still rising. But it's anybody's guess. Such a large gap. What it's going to lead into? It surely will lead into some kind of positive thing in future. When future? No.
Absolutely. And despite the prices being that high, like you rightly said, in 5 years, the prices of properties in Sydney have gone up by 50%. Which is not small, given that the property values already have been a little on the higher side. 50% in 5 years. Although 5 years, other places have gone probably by higher value, but they were also sitting at a lower property prices, right? So that way, 50% in 5 years still a huge growth.
Oh yeah, over the base of, say, if you've reached 1.6 million median value of a house in the last 5 years, and that's a 50% growth over the previous one, which is
roughly 1.1. It was close 1.1 or 2, which has gone up to 1.6
That's
now.
500,000 increase in the last 5 years.
Absolutely.
And the capital increase itself is large over that kind of a large base. It's still Perth and Queensland and Brisbane and Melbourne are just about $1 million-ish in their average value. So from there, rising 50% is phenomenally high. Apartments still, they've got a lot of way to go, but high. But again, of what I've seen, February, Jan, Feb, the dwellings growth has been pretty flat, right? It's pretty flat, which means market is there at its kind of a ceiling. It's not that it's jumping around and it's moving around from there. It's surprising with such a large gap that the market has not moved. Houses, you can understand. It's kind of stable there. It's there. But apartments still being kind of there. So it's kind of being there. No much movement, about 0%-ish, flattish kind of. That means that the market really feels that we are kind of stretched everywhere. Even with the apartments, we are kind of stretched everywhere, which brings a good question, in terms of real income, the income profile of people in Sydney, particularly in Sydney, what does it look like? What do you see in that?
So in terms of real income profile, I think one interesting fact there is that because of such high property values and mostly, of course, everybody owns a mortgage, 45% of the income goes into servicing the mortgage, which is massive.
Huge.
Absolutely. So the debt to income ratio that way goes pretty high. And most people who are like modest incomes, they are just a large part of income. They have to kind of look at their living expenses, that what should they spend on, because almost like close to half the income is straight away going there. So
and whenever we used to calculate, when we used to study and we would calculate how much percentage of, I remember those good old times, we would say, okay, 30-35% of your income goes into paying mortgages or repayments and all that, and the rest is available for you. So you have 10-20% kind of something of that sort as a savings, and the rest is your expenses divided into half paid, with close to 45-50% money going into mortgages. I don't think people are like pretty thin on savings, right?
Very thin on savings.
It's becoming worse for the newer guys who are forced to buy at that high level. They know they won't have a capital growth, but that's what they need to. They want to live there. And so you pay so much for that.
And that's why it's, in terms of pure mathematical calculation, it's like roughly on an average 85 years to own a property in Sydney. Now, that's a lifetime. How many of us will live 85 years?
I know. And some European countries, they have generational mortgages there. So maybe 100 years and 200-year kind of loan terms.
Same like Hong Kong.
So it goes on, right?
It goes on.
Generations keep on.
Few
paying
generations,
for that. Maybe we're going to reach there or something. But that's the good condition of Sydney, where the incomes are, though they are growing, but it's still like that. But again, the other part is the below 1.5 mil segment, that still is having a demand. That's still rising the fastest, because that's where the growth is. That's where people think that that's something which I can afford, and a lot of people are trying to go there. But as soon as it goes beyond the growth is less than 1%. More than 1.5 to 2 mil, growth is less than 1%. It's in some parts, in some price bands, it's even down. It's even down by 1% in some part of the areas, which is it's surprising, because if not surprising, in fact, to an extent, that's the way ceilings work, right? It's not going to happen that people will have perpetually rising income. It's not rising that fast, and RBA rate, cash rate prices is going to make it worse. It's not going to make it easy. It's going to keep on making it worse. One rate rise in Feb has kind of brought some confusion among people. Another one expected in March, another one expected in May. With that may add even more confusion in Sydney, or may just start bringing it down a bit. And I think I was reading an article a few days ago which said the same thing, that Sydney and Melbourne prices may remain softer or may go a bit backward in this year, right?
Yes, stock levels are pretty low, are like 0.25, 0.26%. And then if you compare the liquidity score, which is days on market, which is around 28 days. But the most of the demand is towards up to 1.5 million, because investors still can afford, those who can afford it, a bit of negative gearing, plus the owner-occupied demand because of the first-time buying scheme. So in the segment which is above 1.5 million, it is taking more time to sell properties.
It is taking more time. It's not so easy for an owner-occupier. Maybe an upgrader can still give around. And that may be a thing which is happening in Sydney till now in the last, say, 12 to 86, 15, 16 months, that people are upgrading. So their 1.5 mil property is taken in by people maybe upgrading from an apartment or that kind, or maybe straight going from rental to that bit, because, and that's again a calculation there. If you're paying a rent of 600, 800 and 850, and we'll talk about rental values. If you're paying an 800, 850, 900 kind of a rent, then you are close to about $5,000 a month on the rental thing. That's about a $1 million mortgage. So there will be a tipping point which must be putting people to move there, and that's why the movement is coming in that bit. But again, if you're looking at a higher price range, it kind of is there. But because of this, or maybe because people are wanting to cash out and move out because you're not able to afford, and we'll talk about rental affordabilities as well in some time, still about the average listings running in Sydney is 10% higher than the average last 5 years or something or that, right? And that's an interesting one, because when it's so high, it means that vendors are really looking at moving out of the properties, and a largely investment-driven city, which Sydney has been traditionally, may move more towards being more owner-occupied and people having ownership of their properties. But still, it's still, the demand is still, as we said, along the lower levels, right?
We still have a lower stock on market. But this is the time when we can see the inventory is piling up, because days on markets are going up. The new stock is not coming up. We don't see a lot of construction which is happening, or not a lot of land supply. So stock on market, generally when we see stock on market, because of the new development applications, pretty low. But those who are selling, then upper segment of the property prices, few properties are taking around 45 to 60 days. Auction clearance rate is okay. It's not dropped severely, but still it's not that high. In Sydney, what I can see is there is variety in every suburb. So there are suburbs where you could see a price segmentation varies a lot. Like, for an example, if you look at Hills Council, if you pick up a few suburbs in Hills Council, you could see property prices are in between 1.5 to 2 million, where around 30 to 35% of selling is happening. But there are a lot of properties which are selling in between 3.5 to 5 million also. So because of that segmentation of the price variation, when we look at the data, the days on market, so the liquidity is pretty high in that segment. And that kind of inventory is still piling up. So when we see amount of inventory which is rising in Sydney, in that price buy.
All right. Oh, that's right. And it's also because maybe the entry point available is not only apartments, right? And you don't have too much of an option available for anyone to move into the houses and to buy, because of the affordability section which you are trying to say, right? And that brings us to the purchase affordability segment. What do you see, Julius, in the purchase affordability bit there in respect to rest of NSW? We've talked about Sydney already, but what is happening in rest of NSW there?
It's much better. So when we cross Sydney, go towards the Central Coast, or when you go towards the Newcastle or South Coast, or when we go towards the little inland, the median house prices in combined is around $860,000 versus the unit prices, median houses are in between 670 to 680. So that means the gap between the houses in the unit is not extremely higher.
Yeah.
Plus, the buying affordability is not extremely high too. So rental yields are still better. There are a lot of places where we can see rentals are in between 4 and 5%.
All right.
Stock is very low, not much inventory remaining in the market.
Yeah.
There's enough demand by owner occupiers and investors both.
Yeah.
And then buying affordabilities are still much below 40 years.
Buying affordability is still much below 40 years, which means in regional NSW, if I am living there, I have a chance of having ownership, right? I have a option of having ownership.
Yeah.
The real income profile there of people is it's I can say it's stressed, but it's kind of, I'm really pushed, but I'm still not given up,
Yeah.
I'm still there. It's going away from me, but it's still not gone away. And that's why I think the affordability is this advantage in regional or rest of NSW, not regional. It's this other part of NSW besides
correct.
Sydney, where affordability advantage is there. And that's why you will have net migration moving out of Sydney into the other part of NSW, right? And
just another metric on that. Like we said that in Sydney, it's roughly 85 years to own a property.
Yeah.
The contrasting metric in rest of NSW is roughly 37, 38 years.
Oh,
which
right.
is much, much better. So that one number kind of shows very clearly that affordability is far better there.
Yes.
In last 5 years, property prices have gone up by almost 45% in rest of NSW as well.
Yeah.
Although Sydney has gone up by 50%, rest of NSW overall is 45%. But of course, there is a lot of variation in rest of NSW also. There are areas, it's a large landmass, right? So there's huge variation across different regions there, and I'm sure Julius will cover that later.
Absolutely right. But how do yields look like in both of these segments,
Yeah,
apartments
so-
and houses?
Apartment and houses yields are in between 3.9 to 4.5%. There are locations where we could reach up to 5.5% also.
Yeah.
Especially when we go towards the Central Coast or Newcastle, there are a lot of combinations of house and grannies or the dual income potential properties where the yields can go up to 6.5% as well. So yields are much better. When you look at the renting affordability, it's much below 33% of your income. Yeah. So it's easy to rent houses as well as it's easy to buy houses as well. So for the investors, they can get a good rental because yields are still very close to 5%. There are a lot of opportunities in dual income kind of potential properties where you can enhance your yield. In terms of the buying, yes, as we talk, the affordability is very close to 40, up to 40, around in between 38 to 40 years. So it's much better outlook.
All right. And how does, when we're looking at this, there's always a factor of demand and supply which comes in there. So if we are looking at the other part of, other than Sydney part of NSW, obviously that it's really supported by the lifestyle which it offers. If you're looking at North Coast down to South Coast and Sydney, it's these whole coastal LGAs offer a phenomenal lifestyle, really lifestyle to envy, and that's driving the migration from Sydney to those areas, especially if you can work from home or if you can have, you can work from a remote area or you can find work there. People are moving out because, again, it provides them a much better option. And that's sustaining the demand in the rest of NSW in belts. And I think we will talk about, maybe we'll pick your brains, Julius, on the 5 clusters in NSW at a later stage. But right now, how does the supply and demand and all these factors look like in this part of NSW?
Yeah, so at this stage, I could see a lot of interest is being generated. But towards the Central Coast first, when we talk about Sydney, where you go around 1 hour outside of the Sydney, you can still reach Sydney CBD if you're working in Sydney in 1 hour. Property prices are much below 1.5 million mark. So there is a lot of demand by owner occupiers as well. Also, there are very good, lot of goods above where you can buy properties are in between $900 to $1.1 million.
Yeah.
And your rental income is very close to $950 a week. So we could see there is lots of interest generated in the Central Coast region. If you go a little cheaper and then in affordable segments, then there is lots of interest is being generated towards the inner side, which is when you go towards the Upper Hunter region and Upper Hunter region. Yes, there could be potential of getting more supply, but still not in the pipeline. Over there, the yields are very close to 5% in dual income properties, and the property prices are lying in between $600,000 and $800,000, and then quality of the construction is pretty good.
Yeah.
When we go towards little inland towards Wagga, Albury or Tamworth, Dubbo, their property prices are varies in between mid 500 till up to $750,000, where the yields are in between 4.5 to 5.2%.
Yeah.
So in that segment, in all the segment, when you look at the stock and market is much below 3%, and then inventory is not more than 4 months. So a lot of difference between demand and supply.
Two-speed kind of a market.
Correct.
And coastal LGAs and inland. So different kind of a speed which is there.
Exactly.
And inventory is different there as well. And all that demand is different there as well. And I think that creates more competition towards the coastal LGAs, right?
Coastal LGs, there are a lot of upgrades, and then there are a lot of opportunities for the lifestyle. There are different kind of properties for the Airbnb. There are a lot of retirees also moving there. Property prices are a little bit expensive there.
Yeah.
But still there is a lot of demand. When you go towards a little inland side, that side, basically a lot of investors are interested. So there is a lot of investor movement. But even though the investors proportion is much below 40%.
Yeah. And in fact, one of the things which I've noticed here in the rest of NSW bit is units are still doing better. Unlike Sydney. Sydney is a different animal with respect to apartments, but rest of NSW, along coastal NSW, right up from the top to the bottom, we found that apartments are a very growing, easy entry-level alternative. People are willing to take up versus houses. If the houses are becoming too expensive, they're not really, they're considering apartments pretty well. So the unit houses are doing very well there, and they are a great entry point right now for people who want to jump in, people who want to buy and want to get whether into their first home or whether as an investment. They are serving as an opportunity for people to buy into and to occupy, right?
Yeah, especially towards the coastal LGAs, you can still afford apartments in sub-million, where sub $1 million, where you can have water views. Where in Sydney you have to spend at least $3 to $4 million. So that's the difference. So that's why over there is a lot of demand towards apartments. Airbnb income for those apartments is also very high. Especially when you look at the units towards the regional part of the New South Wales, there are a lot of concepts of block of units, which is on very high yield. And then availability of those type of properties are extremely higher.
Yeah, that's true. And that's a good point. But again, when you're looking at a block of apartments and we're looking at all these specialized properties, people are looking at rental yields which are able to cover the costs. And then you're looking at a good control over strata. And that's a very complex investment. Not everybody does, but that's a pretty complex investment scheme which people get into and own, and they are able to hold on to it and make that's a good wealth creator. Speaking about rental affordability, let's jump back to Sydney.
Yeah.
Okay. What do you see in Sydney? How does it look like in the last 12 months? What did it work and what did not work in Sydney with respect to rental affordabilities?
Yeah. So rental vacancies are tight. Rental turnover is extremely higher. I could see there is a rental rise in entire 2025. Rentals were grown by around 5.5 to 6%.
Okay.
But they are tightening now, even though you have very tight vacancies, but the renting affordability is at the peak.
Yeah.
So median rentals in between $850 to $900 a week. There are few locations where the rentals are more than $1,000 also.
Oh yeah.
So there are very less property available in the market for rentals. But because of the renting affordability, because people are paying around more than 40% of their income towards the rental in most of the places, that's why market is tight, but rental growth is slowing down. Similarly, when you look at the houses, the rental yields, gross rental yield is very close to 2.6%. In apartment, it's a little better. So for $600,000 to $700,000 apartment, the rentals are in between $650 to $700 a week.
Yeah.
So on an average, the rental yields for the apartment is around 4.1%. So in terms of the rental proposition, if investor would like to get into the property market in houses, it's very difficult because your gross is very close to 2.6%. Your net will be very close to 2%. So there'll be wider out-of-pocket expenses because of the dollar value. But when you look at the apartment section, then the gap is not widened as well as the dollar value is less.
That's the only play left for investors in
Yeah.
Sydney that way, right? So at least it will be more controlled cash outflow on a monthly basis versus houses. A lot of people will just bleed. I know of people who have investment properties here and they're like, I want to sell the investment house because it's just not affordable at the current interest rates being on the higher side, the rental gone so low. It's not affordable for a lot of people.
Think on this other side, okay, from a renter side. Even a renter, if you're paying 800, 850,000 bucks a week on rent, even for a rent, they would be paying a large share of their income of their, into rent as well, right? And that's post-tax income. That's a lot of money people are paying, whether they're paying for rent or whether they're looking at paying for buying their own house. But that rental affordability is in terms of Sydney is still being a bit of a thing because you're not able. It's a lot of money which you're paying through that. I know the rental demand. I think it's sustained because we are having net migration of students which are coming in, of skilled migrants which are coming in.
Yeah.
That is really helping keep the underlying tenant demand in Sydney. But again, it's moderated. Obviously, it's moderated from where it was in 23, just after COVID, when it all opened up and there was like, boom, there's no house available and you just can't do anything and you were looking for that. Education is a massive segment in Sydney. Students come here, and I think a large part of students which come across in Australia come into Sydney and Melbourne and all the other cities. But Sydney has its large share of students coming in, and that has also kept the rental demand up for a long period of time, right?
And yeah, absolutely. And combine it with the supply constraint because not a lot of new constructions. I mean, at the demand has softened a bit, but it is still a number of people who are looking for rental properties is increasing. And the supply is still short of the demand, of the increased demand, which is what is keeping the rentals still high and still growing. So both increasing demand and controlled supply, less supply, that's the market we are living in.
And that must be impacting the inventory levels as well, right? Inventory levels must be, what do you see there? Huh?
Much below. So potential rental demand for an apartment or houses are extremely higher. So there is increment in that because of the limited supply of properties which is coming into the market. So at this stage, if you look at the inventory is below 3 months for housing. And when we look at this constraint of the supply, it's a structural constraint. It's not like cyclical.
It's correct. Yeah, it's a structural constraint. It's not just because of for some time. It's not temporary. It's permanent.
It is going to there for a long time unless you release a lot of properties in the market, which is not coming so soon. So basically, it is going to remain there. So affordability is a concern and supply is also a concern.
Affordability and supply both are a concern.
Both are the concern.
And I think construction is also not keeping up pretty well in Sydney. So the cost of construction is so high. Poor guys, it's tough to construct at the value which it will sell. When it doesn't sell at that value, a builder is not able to really afford the construction or don't want to do that. So even though there are a large construction approvals which are coming into Sydney, but because of either the rental affordabilities or because of either the purchase affordabilities, they are constrained. They're constrained about what do they do. But how does it look like? See, if it's about Sydney, then what is it about the rest of NSW? How does it look like in the rest of NSW area?
Supply-wise is still the similar. So at this stage, not much houses are remaining in the market. The vacancies, on an average, vacancies are 1.5%, but that is scattered. There are pockets where the vacancies are below 1% as well. We are investing in a pocket where the vacancies are below, it's around 0.07%. At this stage, days on market to sell properties around 40 to 50 days, depends on which market you get into. But housing gross yields are very close to 4%, 4 to 4.5%.
All right.
Depends on the combination of the property. If it is dual income property is much higher, but on an average is around 4%. Unit yields are much better, like unit yields are around 4.5 to 4.5%.
Yeah, that's good. 4.5% is a good unit yield. Yeah.
When you look at the affordability indexes, better indexes than a Sydney market.
Income,
Income. So basically, rental affordability is very close to 27% of your income.
And I think the rents are also still rising there because there's
Yes.
the rest of NSW is living on the demand which is coming out of Sydney. Overflow from Sydney. So that's keeping the economy going, that's keeping the rentals still increasing there.
Yeah, absolutely right. And I think a large part of the Sydney, from the coastal, I think Wollongong till the central coast, till even going inside a bit on all the sites in Sydney, Richmond and all of these areas, they are still now kind of practically Sydney. You just can be reaching there within an hour.
Yeah.
Yeah, call it Greater Sydney or something. But yeah, it can still reach there. It's about an hour's distance and you can work there and go back and something. So rentals are spilling over into the other parts and people are able to do that in terms of there. So, and how does rental demand look like? Rental demand in the rest of the NSW area? Do you see something different in rental demand?
Yeah, there's a good amount of net internal migration from Sydney towards the original side.
Yeah.
So rental demand is extremely higher. That is impacting on rental prices as well.
Yeah.
That's why, as Modi said rightly, that rentals are rising.
Yeah.
So when we see last year, there is a significant amount of rental have been risen in entire regional NSW, which is impacting onto the yields.
Yeah.
Renting affordability side is much better.
Yeah.
That is allowing the yields to be improved, and that is improving. So that is impacting on the property prices as well.
Yeah.
So at this stage, rental demand is extremely stronger, and there are lots and lots of investors who are investing into the market.
And I think it's also because I think rental demand would also be there. Obviously, it's causing the investors to invest there, but I think rental demand is also there because I think work from home is pretty prevalent in the Sydney, and you can do that, right? So, and if I am priced out of rent, and if I'm having $1,000 rent in Sydney for a normal house, and I can have a maybe 600-ish kind of a rent in a remoter area, and I can still work from home, and I can have a better lifestyle. Coastal LGAs and across NSW offer phenomenal lifestyle. Some of the areas like Kiamas and all are like wonderful areas to live in. What will I do to not live in there? Beautiful areas to live in, right? So it's a structural and a cycle rather than a cyclical bit that the rental demand is being pushed out, and it's permanent, right? It's going to be permanently going out. Sydney is can't go anywhere. It's pretty land and waterlogged, so it's not going to go anywhere, and people are going to keep on migrating there. And when you come out of Sydney, you realize that it's the rental demand with respect to the income levels which are there, it's pretty okay. It's pretty okay. I'm not so stressed. I'm not paying 45-50% of what I'm paying in the Sydney market. I'm much better off, like we said, with 33, 35 odd percent, 40 odd percent, 30, 35% kind of a stuff, which makes it better for me. So it is allowing the sustainability of rental demand in those areas. And I think that must be also driving the rental inventory in these areas. Rental stock is thin because it's going away. People are wanting to come out of Sydney and wanting to live there, and that's what's driving there. So because again, like you rightly said, investors are going there because they are finding capital appreciation. They are going to the pockets where you can find capital appreciation, and you know that the rental demand is anyways there. I'm going to get the renters coming in there. I'm going to have a decent amount of renter supply, which is going to come in there. So I don't really think there. But again, when you look at this strata or apartments or houses, similar, is it?
Yeah, similar. So there are not many apartments or strata units available towards the regional side or rest of the NSW. So the stock of that kind of property is very low. So there is enough demand for the strata properties as well as units and apartments. When we look at the inventory for renting is very low in both the segments. And then prices are still affordable for buying.
Okay.
Because of the affordability, because of the affordable segment into the pricing, lots and lots of investor demand, and there is a good owner-occupier demand as well.
Yeah. That's nice. So that gives a full overall picture of what has happened in 25 till maybe the entire year of 25 and the first month or two in 26. In terms of economic outlook, okay, so that we can go ahead and move ahead and start working on the 26 market. In terms of economic outlook, what do you see, Mudit? How does it look like in terms of NSW versus the entire country Australia picture?
Yeah, that's an interesting one, and especially like we was discussing in the beginning, that there's so much more to when we talk about inflation. I mean, there are multiple things there, right? Inflation and the corresponding impact on the rate rises. So the global scenario is impacting directly. So what was an outlook 6 months ago versus now, it's a lot different than how the world, how the economic outlook on for Australia, for states was. So that's a direct impact. So if the war continues, things, global events continuing will continue to impact. If that goes for longer, then the inflation is going to go up, and that has a direct impact on the costs of purchasing, cost of everything in Sydney. Although Sydney and NSW, the outlook is that it probably will be a little lower than how the overall country's average is, but definitely inflation is very, very imminent, and looks like that it's going to impact our daily lifestyle.
You're right. So Sydney has always been marginally lower versus the other cities like a Brisbane or a Perth, which have always had the inflation levels higher than the national levels. So if you look at the 3.8-ish%, which was there in for entire country in Jan or February 26, but Sydney has been a bit lower, 3.2, 3.25 when we look at treasury figures. And but if you which is slightly lower, I think it's a bit better for Australia. But if you look at the other cities, Brisbane and Perth, they've been all 4 pluses. Perth's been close to 5 when it comes to CPI index, and that's different. That again, housing drives it. Again, same thing. Renters are driving it. Same thing. Electricity costs are driving it. So it's similar there. But when you look at Sydney inflation, NSW inflation in particular, I think the Treasury forecast is that it's going to go down to 2.75 and 3%, which means that cost of living is going to be a bit better off in the future in Sydney. And the prices are pretty sticky. Rental vacancies are low. Construction cost pressures are phenomenal. And the house prices are, as we discussed, in the thin zone, very thin zone. They're just lying there. It's tough. I don't think so next year or two, at least for the whole of NSW, not much is going to be moving towards positively towards the RBA target of coming between 2 and 3% in terms of inflation. So if Sydney, I would say if NSW in particular doesn't come below 3% or maybe substantially below 3%, it's not going to be easily be able to balance out the higher positives of a Queensland and a WA market, which is a bit of a not a great situation to be in. But if I think if it's in NSW in particular, 25 to right now has been a bit better off versus the other states, and it's been nicer. But there's a clear impact on interest rates, right? And in when it happens in NSW?
No, absolutely. Direct impact, because the moment there's inflation, the first thing and one of the important measures RBA takes is that increase the cash rate, which is expected to go back up to 4.35, which is like what it was long ago. I mean,
24.
not long ago,
December
24.
Looks long ago.
Yeah. So that's going to go there. And if you look at the moment the interest rate, cash rate was increased, most of the banks increased their home loan interest rates, passed it on to the consumers. Fixed rates for 1 year and even 2 years have gone up already. The fixed rates are touching 6% with most banks. Plus minus delta there. Not only 1 year, but 2 years. The 2 years means that if it's a forward-looking rate, right? So that means that next 1 year to 2 years, most of the major banks, economists are not expecting the rates to come down much. That's why the fixed rates have already gone up. So from somebody who owns an asset, your mortgage is going to expected to go up further from where it is.
Yeah.
That has to be included in your cash flow calculations as a part of your overall strategy, or whatever you want to do.
As an owner occupier, whenever I'm going to buy, and I think the RBA governors was pretty straight and pretty just clearly saying that all my meetings are live. Like all my meetings are live means I am looking at increasing the rates in every meeting. Unless there is a positive surprise, you're in for a rise or something. Maybe that's what's there, and it's going to keep on pushing serviceability. It's going to keep on pushing borrowing capacity. It's going to keep on pushing the cost of servicing a loan. And worse than that, I think now that there's an APRA cap which is coming in on investments, banks are not going to lend more than 6 times. It's already live now since 1st of Feb. More than 6 times of their book is, I think, 20% of the books or something is the cap which has been put in. There are more restrictions towards the investment cap which is going in. And that's why if we look at an outlook, so what's going to happen in 26 and the rest part of 26, I think NSW will have an impact on the GDP growth which is going to come in. NSW is, I think, for some reason underperforming the both Queensland and a WA market, but still there will be NSW, though it's going to be in line, but still it's going to still have a 1.5% kind of a forecasted growth which is going to be there. There will be stress, okay? There will be stress in large parts of Sydney. People will have a mortgage stress in the year 26 because of the way, if you're already sitting at a 45-50% ratio of your income versus the repayments which you're doing or the rents which you're paying, there is going to be a problem. Unemployment is going to be, as a outcome of this, going to be a bit higher. It's expected to be similar to national average, but on the higher side of the national average. Wages will be okay in real term, and the good part is because wages are going to be okay in real term and the inflation is lower in the state, the cost of living pressures are not going to be as high, but still tighter financial conditions are going to be there, and the more it goes beyond it, the more the worse it's going to be, the more tighter it's going to be. So it's going to be a pretty tightrope walk for the year 26, calendar year 26 in there. But I think it's the way the NSW is, the state is there. It's one of the largest states in the country, and it has its own share of things and all. It also has its own share of what we've been talking, population and the migration increase. How does the outlook look like, Julius, in terms of migration and population? How does it look like it's going to happen in 26?
Yeah, so NSW population growth is 1.2% per annum.
All right, okay.
Which is below national average of 1.5%. And then there is net interest rate migration loss towards the Queensland, and then from Sydney, a lot of people are moving towards the regional New South Wales.
Yeah.
Net overseas migration is not great as well. So basically, there is not great population movement impact towards the Sydney as well as NSW. When we say there is a population movement within the state, that means it creates more opportunities for the housing because they required either a lot of houses to rent, or those who are moving from the other state, they try to buy properties. On property markets, the movement will have an impact unless there is good employment opportunities or the population. So if the population is not rising as fast as we are expecting, then yes, there will be enough pressure on the property prices or houses because of the fact that still there is undersupply.
Yeah.
But the additional pressure which is going to be created by additional population growth, which is going to be little subtle.
Yeah, and again, migrants which are coming in. So migrants straight come to the bigger cities like Sydney and Melbourne, and Sydney in particular has a lot of migration which is coming into it. So student population, the skilled migrant population is holding the rental demand, and it's going to continue to hold the rental demand. I think it's like a pipeline. It's like a water flow which comes in. So you will have a student and a skilled migrant and a temporary migrant coming into Sydney to work because the companies being there and all that. And as soon as they get their permanent residencies or they get their citizenships and they're wanting to have a better lifestyle, they start moving across to the rest of NSW, or they start moving across to Queensland, or start moving across to the other parts, and then they start migrating there and living there. But in terms of, and that's maybe impacts the population growth which is happening in the Sydney market, and then population growth in NSW is kind of getting maintained from there. And that's why coastal LGAs have getting a benefit, because people want to have a good lifestyle, people want to be there, and we've already discussed that a bit, that because of this there's a rental demand which is overflowing and all that is happening. But in terms of population, I think the whole net migrants being out, net migration to the other states, and the migrants and the people, renters coming into Sydney, this thing is good. And And this is why I think Sydney has a very mixed socioeconomic behavior, which happens all the time. I think it's got a good mix of people, good ethnicity of people, good mix of people, various kind of employments of people, various kind of social behavior of people, which exists there. It's I think it's a migrant city, and it's people who are coming in there. And surprisingly, when this is one of the reasons, I think, which is what contributes that to Sydney being the unfortunate leader in the lowest home ownership in across the country. In the major cities it has been. It's just because a lot of people are investors, and they're buying this, and they are fine because they keep on changing. People are not staying as people. So many students are coming, so many unskilled migrants are coming, that people need that. And it's been worsened by the construction cost being so high that new stuff is just not getting made. And we've spoken about this, right? We've spoken about this, how it is there. But Julius, what do you think, what do you see in the socioeconomic context for NSW in terms of the kind of population which is across various areas?
Yeah, so when we look towards the outer Western Sydney, towards the Mount Druitt or Wallen or Trigger, that side, there is most of the concentration of the low socioeconomic clusters, as well as when you go towards the inland regional side, like there are a lot of clusters in Wagga Wagga, or a lot of clusters in towards the Albury Council, or when you look at Tamworth as an example, towards the entire Western Tamworth, Oxleyville, there is a good concentration of the social housing.
Yeah.
So that's the locations where we could see property prices are still lower, because of the fact that the socioeconomic status of that area is not great. Even though things are changing, few areas are gentrifying, but rental demand is still there, but still there is an impact of the property prices.
Yeah, and I think coastal corridors, that's why take a benefit, right?
Yes.
They have a better socioeconomic side, because I think people are choosing where they would want to be there, and then geographically it's creating that. But does that have a wage growth impact as well, Mudit, across in terms of the economic behaviors in NSW?
See, wages have been growing, roughly grew by almost 3.5% last year. So there has been wage growth consistently, primarily because of what do we call it? Movement of people from outside of Sydney, and there have been economic, the infrastructure and by government spending and all that is still causing the wage growth there. So it's not that the wage has not been growing there, but of course, affordability is a larger question there.
Yeah, and I think the interest rates going higher are making it worse. It's squeezing your household budget, right? It's the real income it's squeezing. Though the wage growth is good, but I think the expense growth maybe even higher, or it's making it even worse. And that's going to have a serious impact on both sides, right? It kind of crushes you. The property prices are crushing you. The rental prices are crushing you. Higher inflation is crushing you. Higher the yields are crushing you. So it's putting a pressure onto it from all the sides on people. And I think we're already taxed a lot. We're already taxed to the heights with respect to what's happening with us. But I think in some part of time, I think what's going to also start impacting, in particular, the investors, when you're talking of costs, is going to be land tax in NSW. NSW is again one of the states which had frozen the threshold for land tax across the entire state. And now I can see a lot more people have started talking, okay, this year my investment property has come into the land tax bracket, and I've got a few $1,000 bill, and I've got a $5,000 bill, I've got a $10,000 bill, and what do I do? And that's also putting a pressure on that. Till I think 2 years ago, we used to have inflation adjusted the threshold for that, and that was still allowing you. But now when prices are growing, you're enjoying on one part, but then your house prices are not going to go beyond, but your accessible land values are growing, and your building value is going a bit down. So the 1.075, if I'm not wrong, for NSW, that limit particularly in Sydney is really impacting you bad. Particularly in coastal LG is really impacting you bad. And even trust structures is a bit different here. So, you have trust, like, special trust, your family trust and your discretionary trust and all that. They don't enjoy any threshold, whereas units have a different threshold. If you have a fixed unit and it's not a special unit trust, then you can still have that threshold is still available. So SMSFs, that the threshold is available. There's no exemption. So there is a bit of a play in the land tax bit in NSW, which is going to start making it worse from this year. But I think in 27 for calendar year, it's going to be even worse. In 28 onwards, it's going to start impacting a large number of investors, particularly in Sydney and coastal LGS.
Yeah. No, if you look at it, $1 million is not a small amount. It's been a good threshold that way from a land tax ownership point of view, since it's, on which you start charging. But given the way house prices have been, the property prices have been going up, the house prices have been going up in Sydney, it is not far that a lot of people will start, of course, not the owner occupied, the moment you are investing. It will not be a surprise that a lot of people who are looking at investing here will have to start paying a lot more.
Yeah, and I think it's, as an investor, Sydney is going to be a bit further away from everyone. And just in case if the capital gains discussion, which has been happening, and we are going to, we start discussing in 26 and 27 and 28, if ever the capital changes come in, I don't know, the 33% bit comes in, or the removing it comes in, or they're talking of a different rate and abolishing or capital gains comes in, or whatever they've been trying to do. If that comes in, Sydney is going to be the most impacted area, with the least rental yields which is coming in, which is high property prices, and then on top of that land tax, and then on top of that you're finding that you don't have a capital gain as well, and whatever gain little bit you have a tax on that as well. It's going to really, really drive away the demand, especially from a Sydney and in coastal LGA markets, which are pretty high in value, and that is going to be a bit of a showstopper for investors going forward in this. And that's why it's important for us to to discuss, okay, what do you think as an owner occupier, okay, Mudit? So maybe I should ask you, what do you think as an owner occupier, will there be an impact of what's happening in terms of the rent vacancies and the rental yields and all that? As an owner occupier, is it really impacting me? Is it going to really put me at an advantageous situation or at a disadvantageous situation if all these, when I look at all these things in the year 26?
See, rentals in Sydney are roughly $800-$850 on average per week, which is not a small amount of rent, right? So the rental pressure is there on people who are kind of just there, right? So there's a rental pressure, and there's a push because of the rentals being that high. There's a push on people to buy something rather than paying rent. At least you are making an asset, and that's where but because house prices are much higher, the median being 1.6 there, the idea to buy a unit, buy a property at least where you are not paying a rent and you paying for somebody else's mortgage, at least that feeling, it goes away. So I think that is gonna be still driving it. And the rentals, because of lesser supply of units for rentals, is still pushing the rentals on the higher side. So that pressure will be there to buy rather than living on rent. But affordability, of course, is a question mark there, and that's where the properties which are a little lower value, especially units, I mean, after a certain point of time, it's more about not about growth, whether it will grow up in value or not, go up in value or not. If I'm looking as an owner occupier, it's more about what can I afford and let me just buy that, right?
Yeah, and if I want to get into a market where I want to live in, and if I want to get into a market where I would be wanting to, I say, okay, I just want to own something of my own. I'm sick of being a renter, and I'm like you rightly said, if it's $800,000-$900,000 a week, then you're talking of about $4,500 a month in your outflow for your rent, and that's close to about a 550K-ish mortgage. And if you're a first home buyer as an owner occupier, 550K kind of a mortgage means you can get into an entry-level 2-bedroom-ish apartment in some large parts of Sydney. If you're looking at some other areas, maybe you can get into a 1-bedroom apartment. And if that's something which suits you, you say, okay, I might as well be, I'm better off right now at least paying something of my own rather than having a sunk money which is going into apartments. And if the apartments are, as an investor, I think that the apartments are giving me good yields but not giving me capital growth, or I have all the other issues in terms of costs and yields and everything, and I want to exit out, it's becoming a good symbiotic bit that it's moving from one bit to the other. And we don't know when it's going to really make a move towards owner-occupier being larger in number in apartment ownership versus investors. But like, coming to investors, Julius, what do you think? What's the impact of an investor about these rental vacancies and rental yields which we have seen in terms of ownership? As an investor, do you think that I would want to get more into Sydney market or rest of NSW market or not?
So it depends on the investor class. So basically, there are a lot of people who just want to be in Sydney.
Yeah.
And then invest in Sydney where there's a significant amount of gap between houses and apartment prices.
Yeah.
So there are clusters where apartment supply is pretty low.
Yeah.
And then there's still demand for the apartments where the yields are pretty good. So over there, we could see the demand would increase on apartment sections. But there are a lot of clusters where, yes, apartments are cheaper, but the housing supply of apartments are extremely higher too. That's the places where it will be like a situation where should I go into that or not? Probably it might take some lot of time to witness that capital growth as well. So in terms of the apartment, it's pretty divided. Whether you go towards a market where they're extremely undersupplied, where yes, you could still see a good amount of growth in apartment side, where there are the markets where it's oversupplied. In terms of the regional New South Wales, still there's a lot of opportunities in housing where you don't need to get into the apartment. And then if you look at the supply of the apartments of the units are comparatively lower. In regional side, the affordability is still there in terms of the housing. The property prices are still in the lower margin of in between $500,000 to $700,000 in a lot of places where yields are still in between 4 to 6%. So there's enough pressure on housing rather than apartments.
Yeah, but again, see, if you look at the other way, if I am wanting to buy an apartment, okay, and I'm looking at a rental yield which is going to come in, and units are giving me a great rental yield, right? So even units are giving me a great rental yield, much better than houses.
Yep.
Say in Sydney, definitely much better than houses. So for me, with a lower capital invested, so apartment is costing me lower, so I don't have to invest 1.6 million to buy a median price to buy a house. I can still afford a $800,000-$900,000 thing, and I can still get a 4.5-5% rental yield. So my cash flow negative is not too large. So that play allows me to, as an investor, to tells me, okay, I'm better off buying an apartment here, and I can still get good yields, and my cash flow outflow is not much. So I'm able to enter into an investment game here. Similarly, if I am finding that I have all this migration coming in here, I have all these people coming in here, as an investor, I know that vacancies are less than 1% or something, and 1.5%. So I'm mostly assured that I will get rental incomes.
Yep.
So my risk of rent not being there is gone away. So if my risk has been mitigated, if I am getting into a lower price point, sometimes I will say, okay, I am getting an assured income. So I am an investor, which is okay. I'm kind of I'm a defensive investor. I'm not very aggressive, and I want to invest into something. So this is a good yield, and which is a good yield and a good reliable income. I'm fine. I'm okay with this, and that's why as an investor, it's getting me into a position where I can say, okay, I would be happy to invest whether into an apartment or to a house. And you rightly said that if there is a regional area or there's a smaller area where I can buy a house or I can buy an apartment, and I have a choice and a house is there, maybe I choose a house, maybe I choose an apartment. When it comes to Sydney or coastal LGS, I know apartments are giving me 4.5% rental yield, lower capital inflow, and guaranteed or near guaranteed renters, tenants. I don't have vacancies there at all.
Yep.
So I'd say, okay, I want to invest. Let me do that. So that's an attractive proposition for a lot of investors as well in various asset class, and they can define, okay, that's my capital outflow, and it allows me to invest, right? But again, the good part and the important part in this whole bit is because there is rental yields which are good, I am able to take this risk, right? When the good rental conditions are there. Now, when am I assured? Am I sure? What do I think in 2026, right? Will these rental conditions sustain? Are they going to continue to be like this? Or you think in the horizon there is so much of this stuff is happening, there is a bit of a risk in terms of rental yields holding on, right?
No, absolutely. So that risk will continue. That risk will be there in 26, no doubt. What we say, and whether it's NSW or any other state also, because like we're saying that the chances of rate rises is very, very high. Every rate rise directly has an impact on the mortgage repayments, on the rental increases. So the cash flow will get impacted.
Yes, that's true.
So the yield that you see today, it will get impacted in this year. Now, of course, these are all not long-term phenomena. There's something which is happening in the world which is impacting the inflation and the interest rates right now. So long-term outlook is different, but 26 this year is going to be a little tougher from a cash flow and yield perspective for the investors, especially here.
So I think you're right. So if you, I think there'll be two classes of investors which are always there, but say two classes of investor. I am a cash flow concerned class of an investor. So if I am a cash flow concerned class of an investor, then Sydney apartments and maybe other part of NSW houses offer me something viable. Okay, it tells me, okay, I am going to get a 4.5-5% kind of a rental yield. So I'm preferring that. So I prefer an apartment in Sydney if I want to be in Sydney, or I prefer a house or something else because in the other part of NSW, because that's what is allowing me that, after taking care of all the risk, I'm still getting a good cash flow there. But if I am a capital growth focused investor, I think for me, houses in the rest of NSW and the regional NSW make more sense to me because that's giving me capital growth as well, and that's giving me a good rental yield as well. And I think I am much better off buying there. So that two clear divided class of investors would be coming into 2026, and that clear divide class of investors is going to give me a something, a direction. Okay, which way should I go for, and and which will allow me to say, okay, I want to do this. If I want to clearly say, okay, in terms of Sydney, what would be the, say, a purchase or a purchase outlook? Let's talk of purchase outlook in Sydney in particular. What do you think is going to be in the calendar year 26?
26, Sydney's growth would be modest. Yes, the stock level is low. Demand and supply is a lot of gap. Definitely, there is no supply. The rentals are still a little bit rising. But Sydney is already hit with the affordability. So in terms of the buying, for the investor, two proposition. First of all, they should be a buying affordability, and then they should be a renting affordability. Unless the yields are more than 4%, that investment doesn't make sense because interest rates will be touching 6%. When you're looking in Sydney, and then if you're trying to buy a property which are above 1.5 million sitting at less than 3% yield, then amount of out-of-pocket expenses which you're going to put it into the property is much higher. Then you go towards the other side of the regional New South Wales. So even though the rentals are growing, but they are at the pace where, okay, they are not as much that they can cover all the rental expenses. And at this stage, supply and demand has a lot of gap. But because of the poor affordability, market will not move in upper segment.
It will not move in upper. You're right. And in fact, we've seen that, right? In the last 2 months in 26, we've not seen any movement. It's been so flat, right? It's flat as, it's mostly zero, right? There's nothing which has moved except for the lower price points. Like you rightly said, there's some movement. Otherwise, it's just like that. Days on market are sitting at less than a month, right? It's a seller's market. It's not a buyer's market. It's just structurally still like that, or it's still going to remain like that. We've spoken about the rental or the mortgage thing. 45% of your income. It's going to keep on driving how it is going to be there in the Sydney market, right? And it is always going to keep on driving how the properties are going to be there in the market. It is going to keep on driving how people look at it. I think the segment above $2 million is going to become more and more thin. It's not easy to afford something above that. It's a lot of choices at the lower end, but not too many choices is going to be there at a higher end. Particularly lower end is going to still have a good inventory and movement. Higher one is not going to have. What have you seen? What else have you seen in the inventory market in?
Yeah, so inventory is low, and I could see there is better opportunities being created in higher segments for the upgraders.
Yeah.
Because in lower segment, a lot of people who are much below 1.5 million, they have got enough money when the market was moving between million to 1.5 to 1.6 million. So they've got good money which they are putting those deposit towards the upper segment of the property. In terms of the inventory, yes, inventory is tight and market below 1.5 million. It's moving a little bit. There is a little movement in apartment side of thing because they are affordable. But the upper segment of the market is a bit slow.
It is going a bit slow. And you seen something in like this in with respect to your cash flow and your capital growth as well in the Sydney market, right? You seeing something?
I think
some kind of a similar trend
very similar, that the cash flow is
for 26. Yeah.
for 26 is going to be impacted. Not
Yeah.
It is anyways not one of the highest, not very comfortable high cash flows.
It's not a cash flow
If
market.
somebody is asking for that, I want a positively geared or neutrally geared properties, then this is not the market. Of course, cash flow is going to be impacted, unit or houses both. So that is an important point to be taken into consideration from a sustainability point of view. That can I sustain this year comfortably if you're looking to invest here? Definitely.
Yeah, and I think you're right. So I think both cash flow and capital growth, Sydney market definitely capital growth, it won't have a downside because it's like that we're talking about this throughout this session. It's such a thin zone it's moving into. So the undersupply is going to keep on keeping the demand high, but the price point is going to not let it go up. So it's going to be remaining in the thin band. Capital growth is also going to be very limited. Cash flow is anyways limited in Sydney with by price point which is keeping the rental yields so low. So cash flow is going to always be a bit tighter in 26, going to become even tighter in 26. Capital growth is going to remain tighter. I think interest rate is going to be the biggest factor in for both of this in Sydney market of how interest rate is going to keep on impacting unless there's a rate cut. The more rate rises happen, the worse it's going to become in the Sydney market. So unless there is a rate cut, it doesn't look like this market is going anywhere, right?
Yeah.
But let's say if I look at the regional NSW, what do you see happening in 2026 in this market now that we've seen all of these factors, right?
Regional NSW, like we said, is better placed than Sydney when you talk about overall NSW market. It has gone up in value overall roughly 45%, which has been a decent growth, not very bad growth, decent growth. The overflow from Sydney, affordability is definitely one big factor which goes in favor of regional NSW, which will continue to help investors make some money there. The cash flow, the gross rental yields being a little bit on the positive side, 4.5%, 5% is more sustainable. So that is still a more promising region to look at purely from an investor point of view. Relatively more affordable, supply still being limited and not too much oversupply happening. Gross rental yields still in a range where they make the negative cash outflow limited. I mean, of course, they are still not going to be as a neutrally geared kind of thing, but the net outflow per month will not be too taxing for a lot of people, especially when they're looking from an investment perspective. So it looks overall fine from that angle.
And in terms of purchase outlook, what do you see price rises are going to be with respect to houses and apartments? Just where do you see they're happening in 26?
Data is better aligned in regional New South Wales, as Nandut rightly said. So all the factors which will allow property price to grow are in favor.
Yeah.
So in terms of the affordability is better, which will impact on the property prices. Yields are much better.
Yeah.
So because of the buying affordability, there will be a good owner-occupiers demand.
Yeah.
Also, there is a good net internal migration.
Yeah.
Employment opportunities are better and there are good amount of infrastructure projects. So the employment hubs are getting generated in New South Wales.
Yeah.
Third thing is basically for the investors is better because it's still affordable market. Property prices are still in between $500,000 and $700,000, where your yields very close to 5%. In regional NSW, there's another good thing is out-of-pocket expenses to hold the property is pretty less than other state.
Yeah.
So like your insurance is lower, your council rates are not aggressive, and all the other related cost to the property is lower. So out-of-pocket expenses to hold the property in this interest rate will be much viable rather than you investing in Sydney.
And we've seen that, right? Last 2 months,
Yeah.
the good 8%, 9% growth in the property house prices
Correct.
in the regional NSW, and I think 5-6% growth in the apartment
Apartment
prices in the last 2 years, so which is holding this demand. But again, whether the re-rating which has happened for the entire segment and things become better in the entire segment, whether it's going to be repeated or not, it's a different question. But it still looks pretty strong as an outlook for the rest of NSW to come through, whether it's coastal LGAs or whether it's inside. It's still looking pretty strong, right? And inventory wise, how does it look like? What it will be in the year 26, in the calendar year, next 8, 10 months, 12 months? What do you think it will be in terms of inventory or
stock levels are low and they'll be remain low in coastal LGAs.
Yeah.
So when we go towards the Midland, at this stage, inventory is not extremely high. Few LGs are sitting at very close to 4 to 5 months of inventory, which is shrinking.
Yeah.
So this year probably it will hold around 3.5 to 4 months of inventory, which is not bad. So which is like tight inventory situation. Stock levels are higher. Sorry, they are very low, and then there is not much supply releasing into the market, which will impact on future supply as well. So when we look at the inventory level, it's very tight versus depends on which side of the regional New South Wales we go towards. Especially I could see there is a lot of population movement from Sydney to nearest LGs of the Central Coast, where because a lot of people are not able to afford the properties in Sydney.
Yeah.
But if from Central Coast you can still commute it, and property prices are well below 1.5 million in what of the affordable suburbs, where the quality of the houses are better, affordability is better, and then plus your commute time is not more than 1.5 hours. So that's why there is enough pressure which has been created towards the Central Coast. There is enough pressure which has been created towards the Hunter region. I could say there is a lot of pressure towards the Albury and Dubbo region as well.
All right. So cash flow wise or capital growth wise, do you think it's going to be positive for the regional NSW and the rest of NSW in this year?
Capital growth wise, yes, the property price. So cash flow, let me come to cash flow first. So cash flow wise, it's going to be a little tight. So even if we look at, let's say somebody is investing, even if we look at a 80% loan, it's going to be 6.5% kind of interest rate. So if the rent is roughly 4.5-5%, it's still negative. Overall supply is still constrained. So cash flow will be tighter despite the rental growth. Similarly, from capital growth perspective, there has been a rise in property values and it will continue to rise a bit. But overall, a lot of impact will be on how inflation holds, on how the interest rates keep growing.
Yeah, but
the investor confidence will come from there.
Absolutely right. But yeah, considering that the prices are lower and something is there, let's talk about, let's maybe take a different picture to this. Okay, so if you look for 2026, if we were to divide NSW into the 5 clusters which we were talking of earlier, what let's say the Dubbo, Tamworth, Orange Belt, and then we talk of the Central Coast and Newcastle Belt, and then Sydney, of course, and then going down to South Coast, and then moving inland towards Waggas and the Alburys and all this. Do you think there's going to be a variation in terms of a purchase outlook, property purchase outlook in these clusters, or can we macroize it like this and talk?
Yes, correct. So start with Dubbo. Dubbo South is a bit expensive than the other part of the Dubbo. So where from last 1.5 year, there's a lot of buzz about Dubbo for the investment perspective, where the South Dubbo touched around $700,000 to $750,000.
Still going to grow in 26?
Yes, because of good rental yields plus enough housing demand, and there is not much supply. Inventory is tight, but there are a lot of places in Dubbo which are still in between $600,000 to $650,000. Where the yields are very close to 4.5 to 4.7%. So Dubbo has, from last year, Dubbo is performing and then it will perform so for this entire year. Similar to the Tamworth, southern part of the Tamworth is expensive, so prices will be little sluggish in south side of the Tamworth. But when you look at the Western Tamworth and towards Oxleyville, the property price is a little lower. The property prices are still below $500,000.
Yeah.
Even though there are a lot of the clusters which have a lot of housing commissions.
Yeah.
So if you can select good pockets within the Tamworth region, then yes, there is enough growth opportunities because of the affordability factors as well as the tight vacancies, and the rental yields are much better. When we go towards the Albury region, Albury and the Wagga region, towards the Albury, from last 2 to 3 years, the growth was happening, but still the property prices, it depends on where in Albury. So when you go towards the Targuna side, it's entirely an owner-occupier market where the property prices are reached in between $700,000 and $800,000. Few properties are selling at around $850 to $900 as well. That's a place where, okay, you couldn't expect a lot of capital growth, but in terms of the stable SMSF kind of investment, then there is a good opportunity in Albury. But when you go towards Lavington, Western Albury, North Albury, if you avoid few low socioeconomic clusters, then property prices are still below $650,000 with the rental yields are very close to 5%. So there are lots of opportunities in Albury. Towards the Wagga Wagga, yes, similar prospect with the Albury, where in Wagga Wagga, there are few pockets of the Wagga Wagga which are investable. There are few suburbs which are expensive, but there are still few pockets in Wagga Wagga where property prices are moderate. But there are very few streets which are investable because there is a lot of attention of the housing commission. So Wagga Wagga have been growing. It has grown a lot from last 2 years. So the property prices will be little slower in Wagga Wagga. Towards the Newcastle and Central Coast, for Central Coast, there is enough owner-occupied demand in towards the Gosford, towards the Hamlin Terrace, towards the Ungara, Gorokan and Tokli, where the property prices are well in between $900 to $1.1 million with the rental incomes of around $800 to $900 a week. But there are a lot of house and granny opportunities in Central Coast. So at this stage, the supply score is pretty good. That means there is very low supply. Days on markets have dropped significantly. And especially in open homes, we could see around 20 to 30 families at a time. So Central Coast has a lot of demand, which has been created from last few months, and then it is going to be it is going to be continued because of the very low supply, higher demand, higher owner-occupied demand, and still well below 1.5 million, which is in the radar of a lot of owner-occupiers. In Sydney, as we said before, it will be a little slower. The property prices below 1.5 million are okay. Property prices above 1.5 million, in between 1.5 million to 2 million, there are a lot of upgraders. And about 2 million, it will be too slow.
Yeah, correct. Oh, that's a good way of looking at how NSW is going to be performing in 26, or looking as an outlook for 2026. In terms of rental outlook, okay, what do you see rental outlook? Let's talk from Sydney, and then let's go to NSW after that. Rental outlook, how do you think it's going to be there in this coming year?
So Sydney, if we look at the rental outlook, like we were discussing, the unit rentals are close to 4.1% on an average. House rentals have been 2.6 odd percent. So there is still shortage of properties for rent. There's still migration happening. So, and the rents have been going up.
Growing,
have been going up. The rents
5-6%.
Roughly 5 to 6%. So the rental pressure will continue to be there. The rentals will keep going up, especially given the inflation and given the interest rate hike. There will be pressure on the rents to go up, which is of course going to put more pressure on people to whether they want to continue a rent or not.
All right.
Sydney market looks similar in 2026. It's going to be more
going to
like
be
that.
tighter as well, right?
Yes.
And when you look at inventory, do you see the similar trends there? And in terms of the demands and yields and growth impact of rental yields?
Yes, correct. So rental has a lot of pressure. Not more properties available for a rental, but yes, and then we could expect a little bit of rental rises as well. So rental perspective is good, that yes, rentals are going to grow, but whether it will sustain with your cash flow, yes or no, it depends on the property type. Yields will be still lower.
Yields will be still lower, right? I think in terms of 26, I think houses are kind of not investable in terms of, if you're looking at income for an investment perspective,
Correct.
looking at income basis, houses will not remain as an investable category in Sydney. You can still expect a decent rental growth of 3-5%, but that's kind of similar to what's happening in terms of inflation. So you're not really, real value, you're not really going up. So cash flow, pretty similar in Sydney. Capital growth, if I look at rental's not going to get me any capital growth because I can't afford it, right? So it's going to be pretty flat with respect to any kind of rental growth and any kind of a thing which is going to be impacting from due to this thing that's happening in the rental growth is going to be pretty flattish right now. But with regional NSW, what do you think is going to be happening in regional NSW in terms of the rental outlook on a broad basis here?
The regional W rentals are growing, and then they're still within limit because property prices are still in between 600 to 800 in remote regional, and then towards the central coast they will be in between 800 to 1.1 million. Where your yields are very close to 4.5%, and they're growing. So in terms of when you compare between Sydney and regional or rest of the NSW, when you're specifically looking at the rental, where yes, rentals are growing and rental yields are around 4 to 4.5%, and they're growing. Plus, there is the vacancies are pretty low. So when we do investment hypothesis, then it's more investable because your rental can take care of most of your expenses for a property.
Correct. Yeah, that's right. I think that's how it's going to be. Unlike Sydney, there's going to be still an outlook which is positive in regional NSW, in the rest of NSW, which is going to be there. It's going to be pretty steady again because again your runoff, your value has gone higher. You're having great yields, but it's going to be still tighter, right? Because there's not much of a structural completion of houses which is happening there. So inventories are going to remain similar. Things are going to remain. It's a kind of a status quo year for entire NSW in this year, right? There is good yield which is going to be there. There's going to be a good 3-5% to 5% kind of a rental yield growth in this year in regional NSW as well. But that again mirrors what's going to be happening in inflation. So in terms of real value, it is not going to be much which is going to happen.
It is definitely a little better than Sydney when we compare the two, but it is still not at a level where it can self-fund. So as an investor, if you're looking at sustainability, if you're looking at that, is it going to be easy on my pocket on a month-to-month basis? It's not as rosy.
It's not as rosy as that possible. And all of these also, they eventually, when we're looking at a rental yield in place, when you're looking at how capital is going to grow, when you're looking at how interest rates are going to be there, when you're looking at how inflation is going to be there, there is always a impact on borrowing capacity, and borrowing capacity eventually is what drives a property purchase or an outlook that, okay, I want to invest somewhere. If my borrowing capacity is going to be limited or not up to the mark of where I want to go, or is not going to allow me to reach somewhere in terms of getting into an investment or wanting to buy an owner occupying or property or wanting to upgrade or something, then I will be limited, right? Are you seeing some kind of an impact you see in 26? How will it be working it out?
Well, if you interestingly, when you talk about borrowing capacity, one data that indicates that borrowing capacity is getting impacted is if you look at the growth and the kind of funding non-banking lenders are doing, which are the tier 2 to tier 3 lenders. The moment you have years like this where borrowing capacity is getting tight, you will see that their volumes start jumping, and that's a good indicator to see where is it going, because a lot of the big lenders, the top 4 big 10 lenders, they're a little more conservative, right, when it comes to lending. So when you're looking
more regulated as well,
more regulated, and they have to be tighter on that front, right? But it is a little more lenient when it goes towards the smaller lenders, and they've already started seeing good growth in the volumes. So borrowing capacity is impacted. People will go, who are looking to invest, they will have to go to lenders who are a little more flexible. The interest rate will be probably a little higher, but that's what you have to see. It depends on the times when you're investing. You're looking at right now where the market is little more confusion, little more uncertainty in the market. You want to ride that wave of uncertainty, then there is some trade-off there.
There's some trade-off there, and in fact, borrowing capacity is going to remain a bit negative, like you rightly said, in this year, because in year 26, I'm looking at lower rental yields and higher interest costs once again. So that's going to be making me onto a very poor cash flow situation. So, and eventually my cash flow situation is going to drive my borrowing capacity in terms when I'm an investor, and that's going to be there. And that's where I again really feel that SMSF lending is going to become more predominant in NSW and looking at NSW investors. And like you rightly pointed out a little while ago, Julius, and I picked it up from what you were talking, that belts of Dubbo and Tamworth and Albury and Wagga, Griffith. Did we talk of Griffith? It's a surprising part. Griffith is doing a little bit of a movement somewhere, or Goulburn is doing a bit of a movement somewhere. But anyway, so all of these areas, because of the quality of construction and or maybe the better constructed properties may become interesting for an SMSF lend or an SMSF investment kind of a thing for people, because it's good cash flow. So your good rental yields, which is going to come in there, and expected to have a good capital growth, 4 to 5%, 6% kind of a capital growth. So if you're wanting to be in NSW, pretty good. But do you think there can be a contrarian thought that Sydney units can be favorable for someone who wants to invest into SMSF?
It depends, but in SMSF strategy is long-term capital growth plus a sustainable yield.
Yeah.
When you look at the historical growth of apartments versus the houses, then the houses growth towards in regional NSW also, when you look towards the Orange or Dubbo or Albury, then it's around 8 to 9% historical. That means on an average they grow by around 8 to 9%. Versus when you look at the apartment growth, it's not that significant. So there are better opportunities in SMSF in that price gap where the yields are better in regional New South Wales, in the good pockets of the regional New South Wales where the property conditions are better. You can secure a nice 4-bedroom house for $700,000 to $800,000 where the yields are still in between 4.5 to 5%, and the historical growth is very close to 8 to 9% a year. So there would be a better proposition. Apartment could be an asset which we can consider, but depends on where you're buying the apartment. So
I think also, like you're saying, so although the rental is a little better in apartment, but then there's a strata cost which is into it. So you have to touch, like you're saying, that what apartment, where are you buying, what is the rent, and what is the, not the gross rent, but the net rent, what you get ultimately out of it. Is that sustainable? So I think that's an important factor that has to be there. But like you said on SMSF, I think this year, my understanding is, based on what the market is, that there'll be more investments via SMSF this year, primarily because borrowing capacity is getting tighter. So when that gets tighter, more people lean towards SMSF, and that's a trend we've been seeing for a lot of years. So this year we probably will see continuation of that there'll be more investments happening in NSW when we talk about it via SMSF.
Yeah,
compared to how
I think that's natural as well. And I think over the last few years, people have become diversified investors as well. So in SMS itself as a segment has grown. People are more open to investing into properties through an SMSF. And I think they're more aware, or maybe more choosing to do that. So we've seen that bit happening, and especially we saw this about in year 2024 when people were having constrained borrowing. SMSF lend had gone up. So maybe in the year 26 we will find that SMSF lending takes a uptick, and it kind of moves up a bit in this year which goes by. Now that's interesting. So guys, I think we've had a phenomenal discussion which we've had in the last hour or so. But if I were to quickly summarize what we've been speaking, so what do you think? Okay, let's say Sydney. What do you think is a purchase position and a rental position which comes in through here?
Sydney is okay for an owner occupier where you wanna live there.
Yeah.
For the investment, doesn't make sense. Affordability is bad, yields are bad, property prices are significantly higher.
Yeah.
So market will remain slower for a longer time,
Yeah.
especially in upper segment. And then for the investment, if you don't have enough cash flow,
Yeah.
and then if you've got a lot of money from your pocket versus the amount of capital growth which you can achieve in next 3 to 4 years, the risk is pretty high.
risk is pretty high. But I think you rightly say units will still be, I think we've discussed, will still be the only viable play to happen in terms of renting position, and I want to invest into it. But I think the wages ceiling, the real income ceiling, and all of these are really coming into Sydney. It's going to be a pretty flat market, and definitely the higher segment is going to have a downward pressure into it. How much it can sustain, because we've seen the earlier times, eastern and the higher brackets part of the Sydney and the higher property price of the Sydney gets significantly impacted straight away, and that's going to be seen, I think, like in this year, and that's something which is looks pretty flat and marginal positive outlook in 26. Even rental, it looks like it's going to be rising, but it's not going to be a greatly phenomenal year for both purchases and renting into the Sydney market. Rest of the NSW market, right? Rest of the NSW market, when we it looks better, then it's relatively looks better place to buy into. But what do you think in terms of the purchase or renting position there?
Definitely, that is more affordable. The affordability is a big factor which is going to drive the demand towards regional NSW, and a lot of coastal LGAs likely to outperform the rest of the areas. Better lifestyle, more demand, that automatically drives people there. Net migration out of Sydney. But yes, and the other thing is, this is more on the demand side. The other thing is more on the supply side, which is still constrained, and not too much supply coming into in 2026. Likely to have a better play on purchasing when it comes to the rest of NSW.
Yeah, and I think the rental position is pretty good as well. Less than 1.5% vacancy is going to continue. 4.5% rental yields are going to continue. The overflow from Sydney is going to keep on pumping the demand. So it's like rest of NSW is still well placed into what it's going to go. So we're still expecting that in the year 26 we will have a good 4 to 6% of rental growth, which is going to come in. Good 3 to 6% of property purchase growth is going to come in. I think one of the best income profiles reside in the rest of the NSW area outside of Sydney. So it's going to continue to be boosted by that. Coastal NSW, we've spoken, it's going to be the one of the best markets which is going to be there, and it still has a large undersupply and a good demand which is there, which is going to support the prices out there. So more than Sydney, I think rest of NSW is going to be a bit more attractive in a lot of positions, like the clusters we've spoken about, and that's I think is going to be a big demand driver in this year 2026 for us. So it's a mixed bag, right? It's a mixed bag. NSW is going to be a mixed bag. Sydney is going to be a pretty tough market for people to be in. So it's not in for a great time, and the news about rate rises is not making it easier anyways for us. So good belts, some good belts we've spoken about, which are going to be impacted positively in NSW, and some tight belts which are going to remain tighter, depending again on the price point, right? So a couple of clusters, 600-ish kind of price point, they'll be interesting. Couple of the coastal LGS, some part around $1 million-ish going to be interesting. Sydney is going to be bit different, bit flatter, but yeah, good. I think this state of investment with NSW looks mixed bag. It's pretty mixed bag in what it's going to be in the year 2026. And I think as an investor, you need to really appreciate what you wanted to get into. You need to really talk to your professionals and understand what you want to do and how you want to achieve something. Make a goal, make a strategy, make a plan. Understand what you want to do. It's not going to be an easy market for you. It's not going to be an easy market, both for an owner-occupier, an upgrader, or an investor. So you really need to be sure about what you're going to do and how you're going to do if you're considering NSW as a state of investment for you for the year 2026, right?
Yeah, absolutely.
I think we had a phenomenal discussion. It's so nice to hear to you guys and your views about things, right?
Yeah, it was good.
Yeah, awesome. Thank you so much.
Thank you very much. Thanks a lot.
Thanks a lot.
Bye.
Cheers.
We hope you enjoyed the podcast. If you enjoyed being part of our community today, please take a moment to rate and review the show on your favorite platform.
We don't want conversation to end here. We're all active and ready to chat.
You can connect with each one of us directly via the links below. Thanks for watching. Keep listening. We have a lot of podcasts. Share your thoughts.